What's next for markets?
I'm Michael Kantrowitz, Chief Investment Strategist at Piper Sandler, where I lead the portfolio strategy team ranked #1 on Wall Street in the All-America Institutional Investor Research Survey.
Hello, Emily. Good to see you. So today we are going to be talking about 2Q, and we're going to be going through some of the key themes from the quarter, from the quarterly recap that you put out every quarter and every year for the last couple of years. It's such a great resource. Look back and see the big picture, not just what did semis do yesterday, how's NVIDIA trading today, what were the themes that really drove markets, and how does that set us up for the quarter to come? And it was a pretty incredible quarter. If I recall correctly, this was, for the overall market, the best quarter since 2Q 2020. Am I correct in that?
That is absolutely correct. Yes, this is the best quarter we've had for the S&P 500 in 6 years, and it was impressive very broadly. It wasn't just a large cap win of a quarter. It was across sizing style boxes and across most sectors. Something about this quarterly recap, just before we get into any of it, I think there's something really to be said about looking back and just summarizing where we're coming from. The quarterly recaps started a few years back, maybe 5 or 6 years at this point, because clients were asking individually for these recaps. And I started putting them together for individual clients, and then more and more clients were hearing about it and asking. And so we decided to start just putting this out broadly. And they have gotten to be quite popular just because people do like to do a check-in on what's happened, where are we? And that helps to get a sense of where we're going. And so when we look today at what happened and where we are right now, halfway through the year now, like we said, this was a quarter where all size and style boxes were up, and not just were they were up double digits. Everything except for large value was up double digits. So that is impressive returns across the spectrum. Even large value, which was the laggard this quarter, was up 7.5%. So not too shabby even for the laggard. And interesting to see that it was not large growth that was the big winner this quarter. It was certainly one of the best size and style boxes, but it was actually small growth that was the best performer this quarter. And so that's a different spin on things than what we've seen for much of the last couple of years. And when we look back at this quarter, it's pretty astounding that this was a quarter where we had the Iran conflict was going full steam with a lot of uncertainty. We had a major shift in expectations for what the Fed was going to do next. It wasn't too long ago, back in February, where the expectation was for 2 or 3 Fed rate cuts this year. And now those cuts are off the table. And the question is more likely if and when the Fed is going to raise rates. And so given that we've seen all of that uncertainty with the huge spike in oil and the uncertainty about geopolitics, and then the Fed unlikely to be continuing to ease at this point, the fact that we saw such impressive returns across the board is certainly noteworthy, and something that you probably wouldn't have anticipated if we had told you what the headlines were going to be this quarter. It would be pretty surprising to see how strong the returns actually were.
That's pretty amazing that the worst performing size and style box was up 7.5% in the quarter. Those are some crazy numbers, given all the things that are going on in the world. And then the fact that it wasn't large cap growth leading the way, which for years now has just been the perennial winner. So to see smaller do better, mid do better, all of these names that for a while there were stuck in a rut in aggregate.
That's absolutely correct. This was a pretty big difference from what we had seen. And I think it's also really interesting to note that even though all the size and style boxes were up quite a lot in terms of leadership within the large cap space, there was only one sector that was able to beat the S&P 500 this quarter, and that was tech. Tech was up over 30% in the second quarter alone, which is, for such a massive sector, that's a huge move. And so that means that every other sector underperformed this quarter. Energy was actually down 14% with the drop in oil. And I think digging even a little bit deeper into that, you would assume, okay, if tech is crushing it like it was in the second quarter, you would think, given what we've seen over the last several years, it would make sense for it to have been Mag 7 type of names that would be leading that charge, just because that is what has driven tech outperformance for so much of the last decade. But that is not at all what happened in the second quarter. There was Alphabet did outperform a bit, but most of the Mag 7 names were in line or even down this quarter. And so it really was not the same tech story that it had been. We've really seen a bit of a shift in terms of who's leading the AI trade, basically from who was spending money on AI to now who's making money from AI. And so in this quarter, you saw names like SanDisk, Micron, Seagate, Western Digital, Bloom Energy, all up over 100%. SanDisk was up over 250%. So the really big outperformers this quarter were not the classic ones that you think of as having been the winners over the last decade within tech.
Interesting. Let's talk a little bit about the investing landscape. Wasn't just news that drove this. What was going on underneath the surface that drove markets, drove this equity performance, and broadening within?
Yeah, that's a great question. So yes, there was a lot of news that was whipping markets around, and ultimately we did end the quarter much higher. But under the surface, there was a lot of really positives in terms of fundamentals. So PMIs, which are a very big part of our hope framework and a big part of our process, really continued to do well in the second quarter. We actually are now at a point where every single US PMI, we track all the different regionals out there, all the US regionals that we track are now flat or up in expansion territory, whereas we had been mostly in contraction territory for much of the last couple of years. So we've seen a backdrop where we are seeing more expansion in the manufacturing sectors, and that is something that bodes really well. It tends to correlate well with improving earnings, which is something that we did also see in the quarter. Earnings was by far the big driver of returns this quarter and this year. At this point, even going back to tech has seen such big gains in the quarter and is up on the year so much, but it has been entirely earnings driven, that rise in the tech sector. The tech's PE is actually down quite a bit, about 20% or so year to date. So it has been incredible earnings growth that have been driving what's been going on in markets this year. And it's really, we're seeing earnings growth that's pretty atypical. You don't generally see growth at these type of rates over time unless you're really coming out of a recession. And so it has been very impressive, the growth that stocks have been able to pull out. Actually, at this point, when we look at earnings growth year over year basis, for the first quarter, we saw growth of nearly 30% for the S&P 500. And as we look ahead to the second quarter, which actually is going to be kicking off next week, we start to get the first flurry of stocks reporting next week. The expectation is a little bit lower than last quarter, but still above 20% expected growth on a year-over-year basis for the S&P 500. So we're talking really big numbers, and we're talking really big numbers on an index that has continually had big growth numbers over the last several years. So it really has been a story of improving data, cyclical data, as we measure by those PMIs, and a broad increase in earnings. And now, as I was saying, tech, of course, has had significant gains in their earnings numbers, but it isn't just tech. Tech has just stolen the spotlight because the numbers are so impressive. But broadly speaking, we are seeing that earnings are up across the spectrum. And if we look at the NTM earnings number for the market and we exclude tech, so we don't include any of the tech earnings information in there, it's still up to new cycle highs and up quite substantially. So it is very broad what we're seeing on the earnings front and also what we're seeing on the performance front. So we talked about how last quarter we had a number of all-time highs reached for the S&P 500. It wasn't just a few names that were fueling that. We actually saw 30% of S&P 500 stocks made new all-time highs in the quarter. There were 20 new daily closing highs last quarter for the S&P 500. And so it was broad. Tech was up there having a lot, about 60% of tech sector made new all-time highs. Industrials, financials all had more than 30% of the sector making new all-time highs. So it has been a broadening story for sure. And that's all been based on the fact that we're seeing better data and stronger earnings across the board.
It's pretty crazy how strong earnings have been. So this previous earnings season, which would be happened in calendar 2Q, but was 1Q for stocks. There's that reporting lag. I think you had 80% of stocks beating estimates. So you had earnings that was up, those numbers you were highlighting, and then stocks beat expectations on top of that.
Yeah, that's absolutely true. You said the 84% of S&P 500 stocks beat estimates last quarter when they already were arguably elevated. So it has been impressive. And that is why I think this next earnings season is going to be particularly interesting to monitor, just because the big question people are asking is we've seen this surge in earnings across the board for the most part. Can this continue? Can this last? And in our view, if we're continuing to see PMI data improve and we're seeing those cyclical areas of the economy improve, then yes, you should be able to continue to see earnings stay high and even continue to rise from here.
If the economy's strong, that's the foundation for better company data and not just that secular story of tech. So another thing that happened in the quarter, which hits on this economic theme, is we got a new Fed chair. Any kind of thoughts?
Yeah, that is a great question, one that all investors are thinking about at this point. And I would say that the new Fed chair, Warsh, there is some uncertainty with him now being at the reins. He may be having a little bit less transparency than what we had previously. But I think that ultimately it's really going to boil down to what happens with inflation and inflation surprises from here. Something at this point we just saw this week from New York Fed President Williams was talking about how the focus is almost entirely at this point on inflation because labor data seems to be stable and not a major concern. And so it really is going to boil down to what happens to inflation. We do get CPI this week on Tuesday. So that's going to be a number that really could potentially be market moving because of the way that inflation has influenced not just Fed expectations, but also government bond yields. And so I think that we are probably now moving past peak expectations for Fed rate hikes. Earlier this year, like I mentioned, there had been expectations for 2 or 3 rate cuts. Then we moved into a backdrop where people were investors measured by Bloomberg's work function, Fed fund futures were expecting at least 1 rate hike this year. And probably as we move along through the year, assuming that we don't get another major escalation in the conflict and another major spike in oil prices, we're probably going to see those expectations for Fed rate hikes kind of calm down a little bit. And we think that we are past the peak of those Fed rate hike expectations as we do begin to see, hopefully, inflation numbers, headline numbers in particular, start to come down. The expectation for Tuesday is for a softer reading for headline CPI. And so we're going to be watching that very closely. And so is the Fed. And we heard that from Williams this week, just about how honed in all the Fed members are in terms of what those inflation numbers look like, because they are going to be dictating what they can do from here.
Great, Emily. Thanks so much. I'm looking forward to having you back at the end of next quarter to talk about the Q3 recap. And it's been amazing watching this entity that you've put together grow. I remember about 6 years ago, it was a little paragraph here and there. And now it's this 30-page behemoth that is just the definitive resource of everything that happened in the quarter that you need to note and the context you give about how those are going to go forward.
This is a labor of love, this report. It is, to your point, it's one of the longer ones that we put out, but it's so helpful to do for clients. And as always, we love to get feedback on it because it is something that is always evolving, like all of our work is. So thank you so much for having me on. It's been a pleasure.
We hope you enjoyed today's episode of What's Next for Markets. You can subscribe to the show on Apple, Spotify, YouTube, or wherever you get your podcasts. Be sure to follow Michael on X at Michael Cantro. If you like the show, please let us know by leaving a positive review. The preceding commentary is not financial advice. You should always seek appropriate financial advice from a professional financial advisor in your state. You should not consider this as a substitute for these services. Piper Sandler does and seeks to do business with companies covered in its research commentary or coverage. As a result, investors should be aware that the firm may have a conflict of interest that could affect the objectivity of this commentary. Investors should consider this commentary as only a single factor in making their investment decisions. For full disclosure information, visit www.pipersandler.com/researchdisclosures.